When I first picked up The Intelligent Investor by Benjamin Graham, I thought it was just another finance book. I expected charts, numbers, and complex formulas. But as I turned each page, I realized it was something very different. It was not only about how to make money, it was about how to think about money. Graham does not speak like a trader chasing quick profits. He speaks like a wise teacher who wants you to understand human behavior, fear, greed, and patience. His ideas go beyond numbers. They teach a philosophy of life. The biggest shock for me was this truth. Success in investing has less to do with intelligence and more to do with temperament. You do not need to be a genius. You just need to stay calm when others lose their minds. Reading this book felt like learning how to swim in a sea full of emotions. Some people drown in greed. Others sink in fear. Graham teaches how to float with discipline, logic, and patience. He reminds us that markets are not our enemies. Our emotions are. He shows that wealth is not built in a day, but over time, with small, smart, and consistent decisions. This book does not promise quick riches. Instead, it promises wisdom that lasts a lifetime. Every chapter gave me a new way to look at money, risk, and myself. And the first great lesson Graham offers is also the foundation for everything else that follows. It is the difference between being an investor and being a speculator. Let's begin with that. Lesson 1. The difference between investing and speculating. When I first read this part of The Intelligent Investor, I realized that most people in the stock market do not actually invest. They speculate, they guess, they gamble, and they hope luck will save them. Benjamin Graham makes one thing clear. There is a world of difference between the investor and the speculator. An investor is someone who studies before he acts. He looks for facts, not feelings. He analyzes a company's true worth. He thinks about safety first and profit later. A speculator, on the other hand, follows excitement. He buys because everyone else is buying. He listens to rumors. He checks prices every hour. He dreams of quick money. Graham defines investing as something that promises safety of principal and an adequate return. Anything that does not meet these two conditions is speculation. This simple idea changed the way I think about every financial decision. The investor's mind is like a scientist's mind, calm, curious, and logical. The speculator's mind is like a gambler's heart, restless, emotional, and impatient. When markets rise, the speculator feels powerful. When they fall, he feels helpless. The investor, however, remains steady. He knows that value does not disappear just because the price drops for a while. Graham says that markets will always test our emotions. There will be times when prices rise like a balloon and times when they crash like a wave. In both cases, the investor must stay grounded in logic. He must ask, what is this company really worth? Not, what will others pay for it tomorrow? Speculation is not always evil. Even Graham admits that a small portion of speculative activity can be acceptable if done carefully. But he warns never to confuse speculation with true investment. The danger begins when people gamble but believe they are investing. That illusion leads to disaster. To protect ourselves, Graham suggests a rule. If you want to speculate, treat it like entertainment, not like business. Set aside a very small amount of money for that purpose and accept that you might lose it. Never mix it with your real investments. Your financial safety depends on this separation. This lesson also applies beyond money. In life too, some people live like speculators. They chase instant success, fast fame, and quick approval. Others live like investors. They build skills, make patient efforts, and think long-term. Graham's wisdom reminds us that the path of patience may be slow, but it is safe and certain. When I looked back at my own financial choices, I saw how often I had acted like a speculator without realizing it. I used to follow trends. I used to panic when prices dropped. But after reading Graham, I learned to see value where others saw only fear. I began to study before acting and to wait before reacting. The biggest gift of this lesson is peace of mind. When you stop chasing quick profits, you stop living in anxiety. You begin to focus on quality, safety, and long-term growth. Your money works for you quietly, instead of you working for it nervously. Graham's message is timeless. The investor looks for opportunities built on facts. The speculator looks for excitement built on hope. One sleeps peacefully. The other stays awake in worry. If you understand this first lesson deeply, the rest of the book becomes clearer. Because everything in The Intelligent Investor grows from this single truth. Real wealth is built on patience, logic, and protection, not on thrill or chance. And once you truly understand what makes an investor different from a speculator, you are ready for the next big idea in Graham's philosophy. It is about choosing your style as an investor, whether you want to be defensive and steady or enterprising and active. That is the next lesson I learned. Lesson 2. Be a defensive or enterprising investor. One of the most important lessons I learned from The Intelligent Investor is that not every investor should act the same way. Benjamin Graham divides investors into two types. He calls them the defensive investor and the enterprising investor. Understanding which type you are can save you from mistakes, losses, and stress. The defensive investor is the person who seeks safety first. This investor is not chasing big profits. He wants steady returns and peace of mind. He chooses companies that are strong, reliable, and long-lasting. He avoids frequent trading and speculative bets. His focus is on preserving capital while still earning a fair return over time. The defensive investor is patient. He does not panic when the market falls. He does not get overexcited when prices rise. Instead, he builds a portfolio of high-quality stocks and bonds and lets them grow quietly over the years. On the other hand, the enterprising investor is active and willing to do extra work. This investor studies companies deeply, seeks undervalued opportunities, and is ready to take calculated risks for higher rewards. He may buy stocks that the market has ignored or undervalued. He may look for bargains during market dips. But even the enterprising investor must follow rules. Graham warns that risk is only acceptable if it is controlled, and decisions are backed by careful analysis. Without discipline, the enterprising investor can easily become a speculator, chasing excitement rather than value. Choosing between these two styles is not just about money. It is about temperament and personality. Some people are naturally calm, cautious, and patient. They are suited to the defensive approach. Others are curious, analytical, and willing to spend time studying companies. They may prefer the enterprising style. Graham emphasizes that it is a mistake to adopt a style that does not match your character. Trying to be aggressive when you are naturally cautious will lead to fear and poor decisions. Trying to be cautious when you are active and curious may result in boredom and missed opportunities. For the defensive investor, Graham recommends building a portfolio of large, well-established companies. Diversification is key. Avoid concentrating all your investments in one sector or one stock. The goal is to reduce risk while still earning a reasonable return. Bonds and conservative investments are also important for balance. The defensive investor accepts that growth will be slower but steadier, and that peace of mind is as valuable as profit. For the enterprising investor, Graham suggests being selective and disciplined. Look for undervalued stocks or companies overlooked by the market. Research deeply before buying. Be patient and wait for the right opportunity. Avoid following trends blindly. Avoid impulsive decisions. This style can produce higher returns, but it requires time, effort, and emotional control. This lesson also taught me something broader. In life, we can choose between a defensive and an enterprising approach in many areas, not just investing. Some paths require caution, planning, and consistency. Others reward effort, skill, and strategic risk-taking. The key is to know yourself and act accordingly. Understanding your investor type sets the foundation for every decision you make. It prepares you for how to respond to market fluctuations, how to manage risk, and how to balance patience with action. It also naturally leads to the next lesson Benjamin Graham considers essential for all investors, whether defensive or enterprising. That next lesson is the concept of the margin of safety. Because no matter how cautious or active you are, the one principle that protects your wealth above all else is buying with a margin of safety. Lesson 3. The concept of margin of safety. One of the most powerful lessons I learned from The Intelligent Investor is the idea of margin of safety. Benjamin Graham calls this the heart of investing. It is simple in concept, but profound in its impact. The margin of safety is about buying with a cushion. It is about protecting yourself from mistakes, surprises, and the unpredictable nature of the market. Imagine you want to cross a river. If the water is shallow and the stones are solid, you can step confidently. But if the water is deep and fast, even a small slip can be dangerous. The margin of safety is like choosing the shallow stones. It gives you room for error. It lowers your risk. In investing, this means buying a stock or bond when its market price is far below its true value. Graham teaches that no one can predict the future with certainty. Even the smartest investors make mistakes. Markets can be irrational, businesses can fail, and the economy can change suddenly. The margin of safety protects you from these uncertainties. It is not a guarantee, but it greatly improves your chances of success. This principle applies to all types of investors. For the defensive investor, it means choosing companies with strong financials, consistent earnings, and a history of reliability. It also means diversifying your investments. Buying a stock at a fair price might seem safe, but buying it at a price well below its value creates a buffer. This buffer is what keeps your capital secure when the market turns against you. For the enterprising investor, the margin of safety allows room for more ambitious choices. It encourages careful analysis to identify undervalued opportunities. Even when taking calculated risks, the margin of safety acts as a shield. It allows the enterprising investor to aim for higher returns without exposing themselves to catastrophic losses. Graham also emphasizes that value is not always obvious. The market is often emotional. Prices swing with fear and greed rather than reality. A stock may look expensive because everyone is excited about it, or it may look cheap because everyone is panicking. The investor who seeks a margin of safety focuses on real value, not market hype. This disciplined approach separates the intelligent investor from the crowd. One of the lessons I internalized from this idea is patience. A margin of safety does not mean buying at any price or rushing into opportunities. It means waiting for the right conditions. It means being willing to say no, even when others are buying frantically. The market will always offer opportunities, and the investor who waits for the right price is often rewarded. The margin of safety is also a lesson in humility. It reminds us that no one can control the market. We can only control our own decisions. By building a buffer, we acknowledge the limits of our knowledge and protect ourselves against the unknown. This principle changed how I view every investment. Instead of chasing trends or exciting stories, I began to look for real value. I asked myself, is this price far enough below the true worth of the company? Am I protected if things go wrong? If the answer was yes, I felt confident. If not, I walked away. Ultimately, the margin of safety is about survival and success. It is the most reliable tool an investor has to avoid catastrophic losses and build long-term wealth. It is the bridge between knowledge and action, between analysis and protection. Once you understand the margin of safety, you are ready to learn another essential lesson from Graham: how to view the market itself as a tool rather than a master. That lesson is called Mr. Market. Lesson 4. Mr. Market is your partner, not your master. One of the most memorable lessons from The Intelligent Investor is Benjamin Graham's story of Mr. Market. At first, it sounds simple, even playful. But the deeper you understand it, the more powerful it becomes. Mr. Market is not a person. He is a metaphor for the stock market itself. He represents the emotions, moods, and irrational behaviors of the crowd. Imagine you own a small business, and every day a man named Mr. Market comes to offer you a price for your shares. Some days he is cheerful and enthusiastic. He offers an extremely high price, as if your business is worth a fortune. Other days he is gloomy and depressed. He offers a price far below what your business is really worth. He is unpredictable, moody, and sometimes absurd. Now you have a choice. You can sell your shares to him, buy more from him, or ignore him. The key point Graham makes is that Mr. Market's mood swings are irrelevant to the real value of your investment. His offers are not commands, they are opportunities. A wise investor does not follow Mr. Market's emotions, he takes advantage of them. When Mr. Market is depressed and offers prices lower than the real value of your investment, it is a chance to buy. When he is euphoric and offers prices higher than value, it is a chance to sell. And when he is normal, offering a fair price, you can simply hold. The investor's goal is to act rationally, not emotionally, using Mr. Market's swings to his advantage. Graham's lesson here is twofold. First, the market is unpredictable. Prices fluctuate wildly in ways that have little to do with reality. Panic and euphoria dominate the short term. Second, the intelligent investor does not react to these swings. Instead, he uses them. He understands that value is what matters, not popularity or fear. This metaphor also highlights a crucial emotional skill. Many investors lose money not because of poor analysis, but because they are controlled by Mr. Market. They panic when prices fall and rush to buy when prices rise. Their decisions are dictated by emotion, not logic. Graham teaches us that the market should be treated as a partner, offering opportunities, not a master who dictates our actions. Mr. Market also teaches patience. You do not have to act every day. You wait for the right offer. You do not chase him. You let him come to you. The investor who waits calmly for the right opportunity is often the one who profits the most. This lesson builds naturally on the concept of margin of safety. If you have a margin of safety, you can use Mr. Market's mood swings to your advantage without fear. Low prices become buying opportunities, and high prices may become selling opportunities. The margin of safety gives you confidence to act wisely, while others act emotionally. Another insight from this lesson is humility. You cannot control the market. You cannot predict Mr. Market's mood tomorrow. The intelligent investor accepts this fact. Instead of resisting it or trying to dominate it, he learns to cooperate with it. He uses Mr. Market as a tool, a resource, a partner in building wealth. Finally, this lesson is not only about money. It is about perspective. Life is full of emotional ups and downs. Success and failure, joy and sorrow, popularity and criticism all swing like Mr. Market. The wise person does not react blindly. He observes, waits, and acts with intelligence, patience, and calm. Once you understand Mr. Market, the next challenge is controlling your own emotions. Because no matter how rational Mr. Market may appear, your greatest risk is often your own fear and greed. This naturally leads us to the next lesson. Emotions are the enemy of rational investing. Lesson 5. Emotions are the enemy of rational investing. One of the most striking lessons from the intelligent investor is how much our emotions can influence our financial decisions. Benjamin Graham emphasizes that fear and greed are the two biggest enemies of every investor. While knowledge, analysis, and strategy are important, none of them matter if your emotions control your actions. Fear can be devastating. When the market falls, many investors panic. They sell their stocks at low prices, thinking the loss will grow if they hold. This reaction is natural, but it is rarely wise. Panic leads to poor decisions. Investors forget the principles of value and margin of safety. They forget that markets naturally fluctuate. They sell out of emotion, not logic, and often lock in losses that could have been avoided. Greed is equally dangerous. When prices rise rapidly, many investors feel an urge to buy at any cost. They fear missing out on gains. They chase trends, follow rumors, and believe that they can time the market perfectly. This behavior often leads to buying overvalued assets. The result is a dangerous imbalance between risk and reward. Just as panic can destroy wealth, greed can expose you to unnecessary danger. Graham teaches that the intelligent investor must develop emotional discipline. Calmness is a more powerful skill than intelligence. Patience is more valuable than cleverness. Emotional control allows you to act rationally when the market is irrational. It allows you to see opportunities where others see only fear or excitement. This lesson also reinforces the idea of Mr. Market. The market is unpredictable, moody, and irrational. But the investor who can control emotions does not react blindly to these moods. He observes without panic and acts without greed. When prices are low, He may buy carefully. When prices are high, he may sell rationally. Emotional control gives you the freedom to make decisions based on value, not mood. One of the ways to build emotional discipline is to have a clear plan. Know your investment strategy. Decide in advance how much risk you are willing to take. Determine the price levels at which you will buy or sell. When the market moves, stick to the plan. By having rules and limits, you remove much of the influence of fear and greed. Another key point is long-term thinking. Emotions dominate the short term. Daily market news, sudden price swings, and sensational headlines can create panic or excitement. But Graham reminds us that investing is about the long term. Focusing on the ultimate goal and ignoring short-term noise strengthens emotional resilience. Graham also highlights that no investor is immune to emotions. Even the most experienced and disciplined can feel fear or greed. The difference is that intelligent investors recognize these feelings and do not act impulsively. They pause, reflect, and then decide based on logic, not impulse. This lesson has applications beyond investing. In life, fear and greed influence many decisions. Whether in business, relationships, or personal goals, letting emotions control actions often leads to mistakes. Emotional intelligence, patience, and self-control are always valuable skills. The most important takeaway from this lesson is that controlling emotions is not optional in investing. It is essential. The market will test your patience, courage, and discipline. Those who fail to control their emotions will struggle, no matter how knowledgeable they are. Once you learn to manage fear and greed, you can focus on what truly matters: long-term success. This naturally leads to the next lesson, which emphasizes the importance of time in building wealth. Lesson 6. Focus on the long term. One of the most important lessons from The Intelligent Investor is that investing is not about quick wins. Benjamin Graham teaches that real wealth is built over time, not overnight. The market may rise and fall unpredictably in the short term, but patience and consistency win in the long term. Graham compares investing to planting a tree. You do not expect fruits immediately after planting the seed. You water it, care for it, and give it time to grow. Similarly, a well-chosen investment requires time to realize its true value. Short-term fluctuations are normal. Prices may swing wildly due to emotions, news, or temporary events, but the underlying value of a strong company does not vanish because of a temporary panic. Many investors make the mistake of focusing only on the short term. They check stock prices daily, worry about every market headline, and react to every rumor. This behavior often leads to poor decisions. Selling during a temporary dip or buying during a short-term spike can destroy wealth instead of building it. Graham emphasizes that the intelligent investor must look past daily market noise and focus on long-term trends and fundamentals. Long-term thinking also allows you to take advantage of compounding. When you hold quality investments over years, your wealth grows steadily. Dividends reinvested, profits accumulated, and businesses expanding slowly increase your total returns far more than frequent trading ever could. Compounding rewards patience and discipline. It punishes haste and impulsiveness. Graham also explains that the market is like a voting machine in the short run, but a weighing machine in the long run. In the short term, stock prices fluctuate based on popularity, emotions, or temporary events. But in the long term, the true value of a business, its earnings, assets, and potential, will be reflected in its price. This is why long-term focus is essential. Short-term excitement or panic should not distract you from the real value of your investments. Another aspect of long-term thinking is resisting the temptation to speculate. Short-term speculation may offer excitement, but it is unpredictable and often dangerous. Long-term investing requires discipline, careful analysis, and the patience to wait for your investments to grow at their natural pace. The intelligent investor does not chase trends. He waits calmly for the right opportunities and sticks to his strategy even when others are frantic. Graham also teaches that time is a powerful ally. It allows you to recover from mistakes, absorb market fluctuations, and benefit from gradual growth. Investors who panic during a downturn may sell at a loss, while patient investors often find that the market eventually rewards them. Understanding that time is your friend changes the way you react to both losses and gains. This lesson connects directly to controlling emotions. Fear, greed, and impatience are natural, but a long-term perspective reduces their impact. By focusing on the ultimate goal instead of daily price movements, you can make rational decisions and avoid impulsive actions. Emotional control and long-term thinking go hand in hand. Finally, long-term focus is not just about money. It is about mindset. It teaches patience, discipline, and the ability to see beyond temporary challenges. Life, like the market, has ups and downs. Those who focus on long-term goals instead of short-term emotions often achieve lasting success. Once you understand the power of long-term thinking, the next lesson becomes essential. To make smart long-term decisions, you must study and understand your investments before buying. Lesson 7. Study before you buy. One of the most important lessons from The Intelligent Investor is that knowledge is the foundation of every successful investment. Benjamin Graham emphasizes that no decision should be made blindly or based on rumors. Before buying any stock or asset, you must study and understand it carefully. This is the difference between an intelligent investor and someone who is simply guessing. Graham teaches that every investment should be based on careful analysis of the company's financial health, business model, earnings, and growth potential. You cannot rely on tips from friends, popular trends, or short-term hype. The intelligent investor asks questions. How does the company make money? Are its earnings stable and predictable? Does it have a manageable level of debt? Is its management competent and honest? These questions form the basis of rational decision-making. This lesson also reinforces the principle of margin of safety. By studying a company thoroughly, you can determine its real value. Once you know the intrinsic worth, you can decide if the current market price offers a safe margin. Without this study, you are guessing blindly, leaving yourself vulnerable to loss. A well-researched investment is far safer than one based on excitement or speculation. Graham warns against following the crowd. Popularity does not equal value. A stock may be rising because everyone wants it, but its true value may be much lower than its price. Conversely, a company ignored by the market may be undervalued, offering an excellent opportunity for careful investors. Studying each investment personally allows you to see what others overlook and avoid what others overestimate. The study process also requires patience and discipline. Do not rush into a decision because of short-term market movements. Take the time to analyze annual reports, financial statements, and industry trends. Learn to read balance sheets, income statements, and cash flow reports. This knowledge allows you to make decisions based on facts, not emotion. Another important aspect is consistency. The study should not end once you buy a stock. Continuous monitoring is essential. Markets change, businesses evolve, and economic conditions fluctuate. By staying informed, you can make adjustments when necessary, while avoiding impulsive reactions to short-term noise. Graham also emphasizes humility. Even the most thorough analysis cannot guarantee perfect results. Unexpected events, market swings, and economic shifts can affect any investment. However, by studying carefully and acting based on knowledge, you significantly reduce risk. You are prepared for uncertainty rather than blindly exposed to it. This lesson extends beyond investing. In life, important decisions require research and understanding. Acting without information increases risk and often leads to regret. Whether choosing a career, a business opportunity, or a personal goal, careful study and preparation are essential for success. Finally, studying before you buy connects directly to emotional control and long-term thinking. Knowledge gives confidence. Confidence reduces fear and panic. Understanding the true value of your investment helps you hold steady during market fluctuations and act wisely when opportunities arise. Once you internalize the importance of studying before buying, the next lesson becomes natural. No matter how much you study, you cannot predict every market movement. Trying to forecast the short-term future is a trap that leads to mistakes. Lesson 8. Do not try to predict the market. One of the most challenging lessons from the intelligent investor is learning to accept that no one can accurately predict the market. Benjamin Graham emphasizes that trying to forecast short-term price movements is a dangerous game. The market is influenced by countless factors: economy, politics, business cycles, emotions, and even rumors. Even experts with vast experience cannot consistently predict what will happen tomorrow, next week, or next month. Many investors make the mistake of believing they can time the market perfectly. They try to buy at the lowest point and sell at the highest. They study trends, charts, and news obsessively, hoping to find the secret signal. Graham calls this speculation, not investing. The more you try to predict, the more likely you are to make mistakes. Even a small error can lead to significant losses. Instead of trying to predict the market, Graham teaches us to focus on the value of our investments. What is the company really worth? What is a fair price for its stock? If the market price is below value, it may be a good opportunity. If it is above value, it may be wise to wait. By focusing on intrinsic value, you remove the uncertainty caused by daily market fluctuations. Your decisions are based on facts, not guesses. Patience is crucial here. The market will always experience ups and downs. Prices may drop due to panic or rise due to speculation. These short-term movements do not reflect the long-term value of your investments. Graham reminds us that the market is a voting machine in the short term, but a weighing machine in the long term. If you concentrate on value and hold patiently, time works in your favor. Graham also warns against following popular opinion. Many investors buy or sell based on what everyone else is doing. This herd mentality can be dangerous. When the crowd is euphoric, prices may be inflated. When the crowd panics, prices may fall too low. Acting with the crowd often leads to poor decisions. The intelligent investor acts independently, guided by analysis and logic rather than speculation or rumor. Another key lesson is the importance of consistency. Instead of trying to predict the market, establish a strategy and follow it over time. Decide in advance how much to invest, what kind of stocks or bonds to hold, and under what conditions you will buy or sell. Consistency removes the emotional stress of constantly guessing about the next move of the market. This lesson also reinforces previous teachings. Studying before you buy, focusing on the long term, and maintaining emotional control all work together to protect you from the temptation to predict. You may not know what the market will do tomorrow, but if you understand value, have a margin of safety, and remain patient, short-term surprises matter far less. Even outside investing, this lesson is valuable. Life is unpredictable. Trying to foresee every twist and turn leads to anxiety and mistakes. Instead, focus on what you can control: your preparation, your decisions, and your actions. Accept that uncertainty exists and work with it rather than trying to fight it. Graham's guidance is clear. Stop guessing, stop chasing trends, and stop letting fear or greed dictate your actions. Time in the market and thoughtful decisions matter more than timing the market. Predicting the future is a trap. Accept reality and act wisely. Once you embrace the idea that predicting the market is futile, the next lesson becomes crucial. To reduce risk and increase reliability, Graham teaches that a strong indicator of stability is consistent dividends. Lesson 9. Dividends show real strength. One of the lessons from The Intelligent Investor that has stayed with me is Benjamin Graham's emphasis on dividends. While many investors focus only on stock price growth, Graham reminds us that dividends are a clear sign of a company's strength and reliability. They are more than just a source of income. They are proof that the business is healthy, profitable, and well managed. Dividends are like a report card for a company. A company that can consistently pay dividends demonstrates stability in earnings and responsible management. It shows that profits are real and not just the result of temporary market enthusiasm. Investors can rely on these payments as a steady source of return, even when stock prices fluctuate. This is particularly important during market downturns. While the stock price may fall, dividends continue to provide income, creating a buffer against losses. Graham teaches that dividends are also a measure of honesty. Companies that pay dividends regularly are often transparent about their finances and committed to sharing profits with shareholders. In contrast, companies that retain all earnings without clear purpose may appear profitable on paper, but could be using funds for risky ventures or overinflated growth. Dividends indicate a disciplined approach, where the company prioritizes real, sustainable value over hype. For the defensive investor, dividends are a key anchor. They provide predictable returns and reduce the reliance on capital gains. By investing in companies with a strong dividend history, a defensive investor gains both income and confidence. Even when stock prices drop, the dividend continues, offering a sense of security and reinforcing the principle of long-term focus. For the enterprising investor, dividends are also valuable. While these investors may seek growth opportunities or undervalued stocks, a history of dividends adds an additional layer of safety. It signals that the company is resilient and profitable. It also allows the investor to reinvest dividends, taking advantage of compounding over time. This can significantly increase wealth in the long run, combining growth and income. Graham also highlights that dividends help control emotions. When the market becomes volatile, it is easy to panic about falling stock prices. But receiving steady dividends reminds investors that the underlying business is still generating real value. This reduces anxiety and encourages patience, allowing long-term strategies to play out without being derailed by fear or greed. Another key insight is that dividends reflect the discipline of management. Companies that regularly distribute profits demonstrate a commitment to shareholders rather than speculative ambitions. Investors can trust these companies to operate responsibly and maintain financial stability. Dividends are, in a way, a reflection of integrity and long-term thinking at the management level. This lesson also connects to the broader principles of investing. Dividends complement the ideas of margin of safety, long-term focus, and emotional control. They are tangible evidence of value in a company. They provide a cushion against market uncertainty. They reward patience and discipline. And they reinforce the idea that investing is not about excitement or speculation. It is about steady, reliable growth. Finally, Graham's emphasis on dividends extends beyond investing. It teaches a life lesson as well. Consistency, reliability, and responsible actions create trust and security. Just as a company demonstrates strength through steady dividends, a person builds credibility and stability through consistent, honest actions over time. Once you understand the importance of dividends, you are ready for the final essential lesson Graham emphasizes: patience. Because even with research, discipline, and dividends, success requires time. Lesson 10. Patience builds wealth. One of the most profound lessons from The Intelligent Investor is the value of patience. Benjamin Graham teaches that investing is not a race, but a journey. Real wealth is rarely built overnight. Instead, it grows gradually, quietly, and steadily over time. Patience is the key that unlocks this growth. Graham emphasizes that the market will always fluctuate. Prices rise and fall for reasons that often have little to do with the real value of a company. Economic news, politics, rumors, and emotions can create short-term chaos. An investor who reacts to every movement risks making poor decisions. Patience allows you to remain calm when others panic and to avoid the temptation of chasing trends when others are euphoric. Patience also reinforces the principle of long-term focus. Investments take time to reveal their true value. Companies grow slowly, profits accumulate, and dividends compound over the years. By allowing time to work, the investor benefits from the natural growth of the business and the power of compounding. Even small, steady gains can become significant over decades. Graham teaches that patience is not passive. It is an active choice to act wisely, not impulsively. A patient investor studies carefully, follows a strategy, and waits for opportunities. He buys when prices are favorable, holds when the market swings, and sells only when it is rational to do so. Patience is combined with discipline, knowledge, and emotional control. It is not merely waiting, but waiting with intelligence. This lesson also highlights the connection between patience and emotional control. Fear and greed often push investors to make hasty decisions. Selling during a market decline or buying during a frenzy may seem tempting, but such actions often lead to loss. Patience allows the investor to step back, evaluate the situation calmly, and act only when conditions align with logic and strategy. It turns the market's volatility from a threat into an advantage. Another benefit of patience is resilience. The market will inevitably experience downturns, crashes, and unexpected events. Investors who are patient can endure these cycles without panic. They understand that short-term losses do not destroy value, and long-term growth will often restore and exceed what was temporarily lost. Patience builds not only wealth, but confidence and peace of mind. Graham also reminds us that patience rewards the intelligent investor more than luck or speculation. Quick gains may be exciting, but they are unpredictable and fleeting. Steady, patient growth may seem slow, but it is sustainable and reliable. Over time, the patient investor will outperform those seeking instant gratification or trying to predict every market movement. This lesson extends beyond investing. In life, patience is often the key to success. Whether in building a career, growing a business, or developing skills, results come with consistent effort over time. Shortcuts may promise quick rewards, but long-term patience leads to lasting achievement and satisfaction. Conclusion: the power of intelligent investing. Reading: The Intelligent Investor taught me that investing is as much about mindset as it is about money. It is about knowledge, patience, discipline, and emotional control. It is about understanding value, respecting risk, and thinking long-term. The lessons are simple but profound. Know the difference between investing and speculating. Understand your style, whether defensive or enterprising. Always seek a margin of safety. Treat Mr. Market as a partner, not a master. Control your emotions. Focus on the long term. Study before you buy. Do not try to predict the market. Value dividends. And above all, be patient. These principles are timeless. They do not promise instant riches, but they offer something far more valuable: a path to lasting wealth, security, and confidence. By following Graham's teachings, the intelligent investor navigates the market with calm, clarity, and wisdom. Mistakes happen, markets fluctuate, and surprises arise, but patience, preparation, and discipline allow you to not only survive but thrive. Investing is not a gamble. It is a science guided by logic and a philosophy shaped by experience. And with these lessons, anyone can learn to invest intelligently, building wealth that lasts a lifetime. If you found these lessons helpful and want to learn more about investing, wealth building, and smart financial decisions, make sure to subscribe to the channel. By subscribing, you will get regular insights, tips, and summaries of powerful books like The Intelligent Investor that can transform the way you think about money. Hit the subscribe button now and join a community of learners who are taking control of their financial future. Stay patient, stay disciplined, and keep growing.